Most Canadians do invest in mutual funds or ETFs, but almost no one actually knows how to read a fun fact. And that is incredibly dangerous because in that little document, you will find everything you need to know about that specific investment, whether it's the fees, the risk, the past performance, whether the investment is good or just slowly draining your wealth year after year. First off, if you're new here, my name is Alex. Today, I'm gonna walk you through a fun fact sheet, exactly what sections to look at, what they mean, and how to instantly tell whether or not it's actually a good investment. By the end of this video, I assure you will be able to read a fun fact sheet better than 99% of investors out there. So let's get started. First of all, what is a fun fact sheet? I mean, sometimes it's called an investor facts or fund overview or ETF overview or fund snapshot. Look, either way, it is basically a summary of what's inside the portfolio or the investment. It tells you what the fund invests in, its goals, its fees, its past performance, and its risk level. Think of it as a nutrition label, but for an investment. Not only is it mandatory for institutions or brokers to give you a copy of the fun fact and have you acknowledge the fact that you received a copy of the fun fact, it is also incredibly important for you to read and understand before you start investing thousands of dollars in this portfolio or fund just because you either saw it online or an advisor recommended it to you. Where to find the fun fact sheets? Well, there's actually really 4 ways that you're going to find the fun fact sheet. Number 1 is when you're making a contribution to a fund or portfolio, you will have to acknowledge the fun fact. Number 2 is when you're setting up a pre-authorized payment, you'll have to acknowledge the fun fact, but only at the time of setting it up, not at every transfer. Number 3 is if you're already invested in a fund or portfolio, then you'll receive quarterly statements either by mail or online, which will always include a fun fact. And finally, you can easily find these online. Just type the investment that you're looking for in the Google search bar. In this case, I'll just go to the TD website, find a random fund. Now, disclaimer, this is not a sponsored video. I don't work for TD. I just chose a TD mutual fund because I don't have any money invested with TD or any of their products. I just thought it was the best, most unbiased option that I could use for this video. Real quick, I just want to mention all institutions have what they call their signature funds. As we can see with TD here, their signature fund is the Comfort Portfolios. Here you're going to see different versions of that portfolio, which are just based on risk tolerance. So for today, let's just use this one here, a balanced growth portfolio. I think it's going to be a good example. And where I'm going to find the fun fact, I just need to scroll down. This page here is pretty good. It tells me everything I need to know. The fun fact document is right here. So let's look at this document. So the first thing we're going to see is the quick facts, basically just an overview. So what's important to look at is the date that this actually started. If it's a brand new fund, you won't have much history to look at. Although this one was created in 2008, we're going to have quite a bit of history to look at. Now here you can see that there's $8.5 billion invested in this fund currently. So that's pretty reassuring. But the first thing that you need to look at, forget the returns, forget the fancy description. The number one thing that you need to look at is the management expense ratio. Why? Because the returns are never guaranteed, but the fees are, even in the bad years. If a fund earns 7%, but the fees are 2%, then your real return is only 5%. And losing that 2% over the long term will have a significant impact on your future. Right here, we can see that the MER for this mutual fund is 2.02%, which is about average for a mutual fund. Now, quick rule of thumb here, mutual funds often charge between 1.5 to 2.5% MER. Anything above that is a scam. Stay away. Keep in mind, ETFs usually have much lower fees of roughly 0.2 to 0.3%, and index funds can even go much lower than that. I would say anything above 1.5% deserves some serious investigating to see whether or not it's actually worth paying. And I'm going to show you whether or not an investment is actually worth it in this video. So if the only thing you take from this video is to look at the management expense ratio, you are already going to avoid about 80% of the bad investments out there. The next section is the investment objective, and it's always going to look a little something like this. The fund seeks to generate long-term capital growth by investing primarily in ... It's going to tell you what the fund is trying to accomplish. It's also going to tell you what it invests in. However, if you're like me, you'd rather just see it for yourself, right? So in the fun fact, you're going to see the top 10 investments. Now, we are looking at a mutual fund. So a mutual fund is basically just a combination or a big shopping cart of other funds. So if I look at the top 10 investments, it's not actually telling me where my money is going. I can see that the number one biggest investment, which 27% of my money is in bonds, Canadian bonds, and we can also see it here. Now, if I want to actually see where my money is going, I will just take this fund right here, which is 16.5% of my money is going towards this fund right here. So what I can do is just go here, do a Google search, and try to find the exact fund that I'm looking for. Now I can see here, first of all, you're looking for the O series. I'm just going to go with the investment series because the mutual fund we're looking at is also the investor series. So let's go here and let's find the fund fact. So the top 10 investments in this fund, number one is Meta. Number two is LPL Financial Holdings, Broadcom, Paychex, and so on. It also tells me, okay, 65% is in the United States. We're about 23% in IT, 19% healthcare, 14% industrial, and so on. So this is one way of checking where my money is actually invested when you're invested in mutual funds. And I know it's not very clear, but if we look at the investment mix, this is actually just a summary of where my money is going. So when we're looking at investment mix here, the word equity just means stocks. You are investing in the stock market. You are investing in companies, in their growth. So we can see that global, 40%. Now, global for us just means outside of Canada and the United States. Now, you can see that the second biggest one is Canadian bonds. Now, usually in mutual funds, when you're investing with financial institutions, they are government bonds, which are very, very, very low risk. But low risk also tends to mean lower returns, especially during higher inflation years. Bonds lose their value. That's a topic for a different video. Now we can see here 14% is going towards Canadian equity, about 10% in US equity, and then there's global bonds. This gives you the asset allocation of this specific mutual fund. Now, most funds will show a risk bar with categories like this one, low, low to medium, medium, medium to high, and high. Here's what most investors don't actually know. This risk rating is not based on the risk. It is based on the volatility alone. Now, volatility doesn't mean bad. Volatility just means how fast or how quickly your cash or your investment will fluctuate. The more volatile, the more quickly it will fluctuate. So the fund fact sheet's risk rating is purely a guideline. Now let's look at the past performance, and here's the part that they must always emphasize. It's that past performance does not predict the future returns. Now, of course, that's true. However, it's still a pretty good indicator. Now, what performance can tell you is how the fund behaves in certain markets or during a crisis. Also, how it compares to its index. It also tells you whether the fees are actually dragging on the returns and whether or not the fund is consistently underperforming its benchmark. Now, a quick thing I'd like to mention here, these returns are all net after they have taken off the management expense ratio, so you don't have to factor that in. These returns are already net after the management expense ratio. So we're gonna look here, but we're also gonna look for its benchmark. Now I can see that these are the benchmarks. So this is what it's being compared to. So let's just say, for example, I'm going to take this. So let's say you found a mutual fund that takes the S&P TSX Composite Total Return Index. So here is the annual performance of this index. So for 2024, the index had a 21.65% return. And if we look here, the mutual fund only did 13.5. So it significantly underperformed. Next up, 2023, 11.75. The mutual fund actually did pretty good considering that you also have a 2% fee. Now, 2022, the index lost 5.8%. However, the mutual fund lost 11%. Next, 2021, index made 25%. Meanwhile, significantly underperformed again. 2020, the index made 5.6% and the mutual fund did the same exact return. So it actually outperformed. Remember your management expense ratio. 2019 was almost 23% for the index. Meanwhile, it significantly underperformed yet again. All that to say that this mutual fund is significantly underperforming the S&P Toronto Stock Exchange Index. Now let's take a look at an exchange traded fund or an ETF that aims to simply mirror the S&P TSX index. Let's go find the fund fact sheet. Here we go. The management expense ratio for this ETF is 0.06%. You are paying almost nothing in fees. Do you see the difference? And look, the benchmark 21.65. It is the actual return, 11.75 for 2023. Yeah, so they have the correct benchmark here. We can see that this fund, 21.53, 21.65, very close, 11.6, 11.75. Lost about the same, made about the same, made about the same. Look at the difference here. This one is making the same as the benchmark, 21%, 13%, but you're paying a 2% fee for this mutual fund. This is why I always say go with ETFs rather than mutual funds. Just even if you don't know what you're doing, find one that mirrors an index. They're still going to be updating it if the index changes. Now, a quick word about tax. It is true. So if you're investing in mutual funds, then these are capital investments, meaning that if you incur a gain, these are capital gains. And half of that gain is called the taxable capital gain, which means that taxable capital gain will be added to your income and is fully taxable. This part basically says that you should only invest in mutual funds in RRSPs or TFSAs or FHSAs, anywhere where it's tax sheltered, because the fund advisors will sell and buy throughout the year, and it's going to cause a lot of capital gains for you if you're not in a tax sheltered account. So this mutual fund talks about a commission between 0 to 0.75% of the value of your investment each year. Once again, ETF that mirrors an index fund, you avoid all this. Couple useful things to know here. You do have 48 hours to change your mind or to cancel your purchase without any penalties. Now, there is a 2% penalty that you would be paying. It's called the short-term trading fee here. If you trade to another fund within 7 days of purchasing them, this is just this fund specifically. Now, there is the 48-hour thing that we just talked about, so it wouldn't apply in the first 48 hours. This is just this specific mutual fund. Now, other mutual funds might have other similar fees like this. So that is the video. That's how you look at a mutual fund fact sheet or an ETF overview or an investor facts, whatever you're looking for. This is how you go through that document. I hope you got some value out of this video. If you did, please be sure to hit the like and subscribe button. Truly the best way to help me out, and I would really appreciate it. That way you won't miss one of my future uploads once they are posted. With that being said, thanks for watching, and I'll see you in the next one.